you ever seen a unicorn? You don't think unicorns exist? Sure, they do. And we are seeing more of them. In the financial sector, the term unicorn refers to young startups that are not yet listed on the stock exchange, but are already valued at more than $1 billion by investors. 10 years ago, only a handful of these types of companies existed. Over time, this number has increased to around 500, and this has turned into a real unicorn plague. Plague? What's the problem, you may ask? The problem lies in the growth strategy of most unicorns. For them, sales growth is a top priority. Usually, sales growth is achieved through aggressive market share gains. In the meantime, profitability plays no role and is secondary to the expansion into global markets, sometimes even for decades. The e-commerce marketplace Amazon, today the world's third most expensive listed company, is considered a role model by many. If a unicorn enters the market, there are significant consequences for well-established companies. One example is Uber, the multinational transportation network company, putting pressure on taxi businesses worldwide. At its IPO in May of this year, Uber was valued at $75 billion, even so the company itself questioned whether it would ever become profitable. So how can other companies compete against the Ubers and Amazons of this world if the new competitors are not focused on making profits? It is a very unequal battle, and this is exactly where we see one of the main reasons for the incredibly weak development of value stocks compared to growth stocks. The structural market distortion caused by unicorns is huge and affects the business models of today's value stocks in particular. When will the poor performance of value stocks end? Given the success of the unicorns, this is less a question of valuation. The more important question is, how much longer will investors be willing to finance unprofitable growth on such a large scale? So far, there is no end to this trend in sight. Furthermore, investments in the three-digit billion-dollar range continue to flow into this segment. How do we handle this in the Ethna-DYNAMISCH? High quality, solid growth and sustainable competitive advantages with an appropriate valuation. These are the criteria that we look for when selecting our single stocks. At the same time, we avoid structurally weakened companies, many of which could turn out to be value traps in the future, despite their current low valuations. As a result, we have a robust equity portfolio, so not even unicorns will be able to cause us sleepless nights in the future.